Norm became a client of Mercer Capital in the 1980s. He had an ESOP at his company, and we valued that company for quite some time. By the 1990s, by the mid-1990s, Norm was in his 60s, and I talked to him at some length about what his exit plan was, what his business end game was, and he basically ignored me. So we continued to work with Norm for a number of years. Then a few years ago, Nick, one of our analysts, was down at Norm's company, and Norm is not his name, but was down at Norm's company. He called me and he said, "Chris, you've got to talk to Norm." And I said, "Well, what's going on?" And he said, "Well, Norm is just really frustrated. He went out last weekend and wanted to buy a bass boat. It cost $25,000 and he couldn't put together enough cash to write a check that would clear on Monday morning to pay for the bass boat. So he had to take out a loan." Now, Norm's not a poor guy. He's got stock worth $25 million. He just had no liquidity whatsoever. So I did talk to Norm. I talked to him at some length, and I found out that not only was he frustrated about the bass boat, he was absolutely frustrated because his wife was on his case and had been for some time, because you see, she knew that if something happened to Norm, and Norm's 10 years older than she was, if something happened to Norm, she was dependent on the company and on the unproven management abilities of the children that she had in the business. So she was absolutely on his case. So I talked to Norm at some length, and we said, let's put together a game plan to create some liquidity and do some of the things that need to be done with the company. I said, we can't be your ESOP appraiser anymore if we do this, because we're going to be getting into issues that would call our independence into question. So we said, we're going to convert you from a C corporation to an S corporation. Norm had a C corporation, but he also had an employee stock ownership plan that owned about 30% or 35% of the business. Well, I don't know if you're familiar with the tax advantages of an S corp ESOP, but I get a Christmas card from the CFO every year thanking me again and again for making that conversion. We're going to have a functioning board of directors, because Norm had not had a board meeting in 25 years. We're going to hire a COO, a Chief Operating Officer. This was a $200 million business, and Norm had a management philosophy. He said, "My management style is one of benign neglect." Well, what that means is that he hadn't been to his far-flung operations in a long time, because he was in his 70s at this point. So we hired a COO, and then so we had to do these things. And then we're going to get some liquidity. We're going to get $10 million of liquidity outside of the business. So we got together. I spent a fair amount of time with Norm. We put together a board of directors that actually functioned. We hired a chief operating officer who began to train his grown children in the business and take care of a number of other things. We converted to an S corporation, and then once we had a few things in place, then we went to a regional bank and we put together a loan, a $12 million loan, so that the company could borrow the money and the company could buy back $12 million of Norm stock, so that Norm would have $10 million of liquidity outside of the business. Well, his wife was quite happy when that occurred. But we did all that over the space of a couple of years. Then the company continued to perform and did quite well, paid off the loan over a period of 5 or 6 years, and then 2008 came. This company was associated with, very closely identified with, the housing industry. So what that means is that they went from $200 million in sales and $7 or $8 million in profitability to $100 million in sales and barely $1 million in profitability. He's one of the few companies in his industry who maintain profitability. The point, though, is that when 2008 came, he still had his liquidity outside the business. If he had waited until 2008, he would have had no option for liquidity whatsoever, or he would have had to sell the company at distress prices. Well, Norm has gone to his greater reward. His family still runs the company, and they are, I think, quite pleased that Norm made a few key decisions along the way in the latter years of his life to create liquidity. So that's a story of Norm. I'll come back to him. You know, there are 76 million boomers in America, and there are quite a few of you here. I'm younger than that, you know. But in any event, boomers are turning 65 at the rate of 10,000 per day. 10,000 per day. That's one every 9 seconds, ladies and gentlemen. The boomers own about 2/3 of all businesses, and if you look at the real businesses out there, these statistics pertain to mom and pops and that sort of thing, but if you look at the real businesses out there in America, I think you'll find that boomers are at least 2/3 represented in terms of ownership. Now, we're going to be turning 65 at the rate of 10,000 a day for the next 19 years. There's never been such a generational surge in the history of America. I like to think in terms of now, the current status quo. Norm had a current status quo that was upset by his inability to buy a bass boat and upset by his wife's insistence that he do something. But the current status quo is wherever you are right now with your business life. There is a business end game that we all will face. We will all transition our ownership. We will all transition our management. So there is a business end game. You may not articulate it, but you may need to articulate it. There are people in this room that can help you articulate that business end game. In between the current status quo and the business end game is what I call interim time. And that's the time in which every business owner needs to make probably 1 or 2 or 5 or 6 key decisions and implement them so that the business end game is good. Because you see, the business end game, it doesn't just end with the sale of your business or the transfer of your business, because that long line to the right is the rest of your life. One of the things that we all need to do as we think about our business end games is think about what are we going to do after we sell? What are we going to do after we step down from the management of a business? How are we going to handle this situation? Because it is a fact, I read a study, so it must be true, that 2/3 of business owners are unhappy within 6 months after they've sold their business. They're not necessarily unhappy with the price. What they're unhappy with is that they didn't figure out what they were going to do after they sold the business. So one of those key decisions that we need to think about between now and the business end game is what do we do after that? Now, I'm not a psychologist and I don't counsel people and that sort of thing, but I just know from personal experience, my own personal experience, and the experience of many clients, that you better have an idea of what you're going to do when you stop doing what you're doing now. There are some common themes in the management of wealth. One is that wealth tends to be treated as an investment. Many of us have profit-sharing plans. We have money that's managed by other people. And what do we do with those funds? We entrust them to somebody that's capable, and we pay them management fees. We pay them management fees. So that's an important thing to remember. Now, let's look at what I call the business transfer matrix. I said earlier that you will transfer your business. You will transfer your business in whole or in part, voluntarily or involuntarily, or as a friend of mine said, vertically or horizontally. You know, It's, you're going to transfer your business. There's no way out of those boxes. You're going to die. You're going to get a divorce. I had one gentleman, he was a client. He owned 50% of a business. His wife owned the other 50% of the business. He was running the business and fired her. They were in a process of a divorce. So he was trying to buy her out. Well, it's hard to buy 50% of a business sometimes. They went to court. There was a battle of experts as to what the business was worth. And I said it was worth probably $100 million, and some other guy said it was worth $160 million. The judge said, it doesn't matter what the experts say about value. What matters is this couple has convinced me beyond a shadow of a doubt that they cannot work together and they will not work together, so the only equitable solution is for me to order the sale of the company. And that's exactly what he did. And the company brought surprisingly close to what I valued it at. But in any event, you're going to transfer your business. So keep that in mind as we talk about it. We talk in terms of rates of return for our investment portfolios. Our profit sharing plan at Mercer Capital is invested with a company called Diversified Trust Company in Memphis. I get an email from Diversified Trust every month that tells me the performance to the nearest tenth of a decimal point. I get, that's net of fees, of course. I get a report every quarter, and I get a visit 2 or 3 times a year as a trustee, my co-trustee and I do. And we talk about what's the rate of return on the portfolio. It's quite simply dividends plus realized gains or losses, and plus any unrealized appreciation or depreciation over the beginning value of the portfolio. Now, this is basic stuff when you're talking about liquid assets. It's not basic stuff when we talk about private companies. Mr. Jones has a $5 million portfolio. His investment manager has created a diversified portfolio for him. It's probably 2/3, 60% equities and 35 or 40% cash and bonds. And so it got, in the year in question, 11.8% return. And he knew that return precisely. It was a good return in the market. The investment manager thought he had created a little alpha. But Mr. Jones owns Jones Manufacturing. It's a $20 million business. So when I put the $20 million business in his pie chart, we get the same kind of picture that Jim was talking about in his opening remarks, where we're absolutely concentrated in our ownership of the private company. So 80% of his business is in Jones Manufacturing, and Jones Manufacturing in that year got a 7% return. I know that because I guess I valued it. What kind of return did he get on his portfolio? It wasn't 11.8% like he got in the market. It was 8% because his weighted average return, taking into account his 80% weighting with a 7% return on the business and his 20% weighting on his liquid assets, gave him a blended return of 8%. Now, if his investment manager had yielded 8% or 7%, he'd probably be looking for another investment manager. Idea number 1, if you're working with business owners, talk to them in terms of rates of return. If you're a business owner, think in terms of what rate of return did I get on my business? Now, I know some of you are going to say, well, I don't care what rate of return I got. It doesn't matter. I'm going to own the business for a while. Well, it does really matter if you're thinking about your business end game, because the return will influence your ability to end your business life. I created an idea a number of years ago. I gave a talk on buy-sell agreements at the BEI, the Business Enterprise Institute, I think it is, John Brown's group, and on buy-sell agreements. And it was a lengthy discussion. My first book on buy-sell agreements had just come out. It was 2007. I got a call from a gentleman at Lincoln Financial a few months later, and he said, can you do a talk for us in October, whenever it was? And I said, sure. I'd be glad to talk about buy-sell agreements. He said, I don't want you to talk about buy-sell agreements. I want you to talk about that idea of the 1% solution that you mentioned. Can you do that for an hour? I thought about it, and I said, well, sure, I can do that for an hour. And I'll write a little booklet that we can hand out to everybody. Well, the 1% solution basically says, just like you pay 1% or 80 basis points or something for the management of your liquid assets, consider a percentage of the value of your business as creating the budget that's necessary to manage the wealth in your business. If you have a $20 million business, that 1% would be $200,000. 50 basis points would be $100,000. So there's a little chart in the handout material at slide 14 that just shows you graphically what I'm talking about, but we've covered the concept at this point. Business owners say, why do I need to do that? I'm running the business every day. My point is that it is an absolutely different function to run the business. It's a good thing you do because somebody's got to run the business. Managing the wealth in the business is a totally different function than running the business itself. It involves different activities. What kinds of activities? Well, the 1% solution might create a budget for an annual appraisal. 20 years ago, I spoke to groups of business owners and I suggested that they should all get an annual appraisal. I guess I did that at that time because I thought it would be good for my business. That was a joke. So today, every time I'm in front of business owners or business advisors, I make the recommendation that if you have a successful, closely held business, multiple millions in value, that it's a good idea to have an appraisal every year or every other year, at the very least. If you have more than one shareholder, you've got a buy-sell agreement. I have another book, Buy-Sell Agreements for Closely Held and Family Business Owners. I've been addressing buy-sell agreements for many years because I guess I was well known in the appraisal field and I started working with buy-sell agreements. I've been the third appraiser in buy-sell agreement disputes many times over the last 20 years or so. What I can tell you is that buy-sell agreement disputes, this is a technical term, ladies and gentlemen, they suck. They're no fun, they're expensive, and there's really no reason for them to come about. I'll tell you why in a little while. But annual appraisals for monitoring performance, annual appraisals for the buy-sell agreement, pricing, life insurance funding, ownership transition planning, corporate finance for private business. I'll talk some about corporate finance for private businesses as we proceed. Idea number 2, the 1% solution. Relate the value of your business to the budget that you're going to create to manage the wealth, because managing wealth is a separate function than managing the business. Some valuation concepts for management and ownership transition. If you were to awaken me at 3 a.m. after an evening of personal abuse, just shake me awake and say, Chris, what's the definition of fair market value? I would jump out of bed and I would say, fair market value is the hypothetical price at which a hypothetical willing buyer and a hypothetical willing seller, both of whom are fully informed and neither of whom is under any compulsion and both of whom have the capacity to engage in a hypothetical transaction. Then, of course, I'd go back to sleep. Fair market value, though, is a concept that business appraisers understand. It's a concept that goes well with pricing for buy-sell agreements. It's a concept that is required for a gift and estate tax planning. So we need to have some idea of fair market value. But fair market value of what? You see, many people think they know what the value of their business is. Business owners think that, but what I can tell you is that if you're a business owner, it really doesn't matter what you think your business is worth. It only matters what I think as an appraiser for gift and estate tax purposes or for purposes of the buy-sell agreement, or what, when you go to sell, a buyer of capacity thinks that your business is worth. So what I just tell business owners that what you think about the value of your business is irrelevant, and it's probably wrong. You probably have either an underestimate or an overestimate. But anyway, and one of the reasons that it's wrong is that there are multiple values for your business. There is something called strategic value, which is the value, I call that payday, someday, maybe. We all would like to sell to a strategic buyer. Heck, I don't want a strategic buyer. I want an irrational buyer. But we may get that price someday. On the other hand, if we're making gifts to our children to transfer the ownership of a business, we transfer that at what's called the non-marketable minority level, and the appraiser will legitimately employ a minority interest discount perhaps, but certainly a marketability discount, and get to this lower value, this non-marketable minority value. So that's another value of the business. The one in between, I call it financial control, is the kind of value where most business transactions occur. That's where most buy-sell agreements get priced. If you and I are in business and we are going to set up a buy-sell agreement and we're going to determine the pricing for an appraiser to create the methodology, you won't agree to a strategic value, because if I go first, you're going to pay that strategic price and you won't think that's good. I won't agree to a non-marketable minority value, because if I go first, I couldn't have my estate receive such a low value. Ultimately, we'll agree on that middle value or financial control. So we have to have some idea of these different levels of value and why they are in fact different. So let's talk a little bit about tools. We've talked about managing wealth, looking at the rate of return in your business. Now, what can we actually do? Well, one of the things that I talk about is dividend policy. I would tell you that every company has a dividend policy. Every company has a dividend policy. If you don't pay a dividend, that's your dividend policy. If you pay out all of the earnings of your business in a pre-tax bonus, then that's your dividend policy. But every company has one. Special dividends. Many private companies accumulate cash on their balance sheet. Many companies accumulate all sorts of trash on their balance sheets. I advocate getting the excess cash and the trash off of balance sheets, because when you go to sell your business, what you'll find is that you have that condo down in Destin, Florida. Well, the buyer has no interest in a condo in Destin, Florida. And what I've learned is that once you get in the middle of a transaction, it's hard to get property out of a business. I mean, it's difficult. It takes time. You have distribution issues and that sort of thing. So get it out now and pay for it otherwise. If you have excess cash, get it out. Well, a lot of people don't want to pay dividends to Susie. Susie's got a little stock. Or to George, because George is irresponsible. Well, he's not going to get any more responsible when you give him the stock, when you give him more stock when you die. But you get that excess stuff off the balance sheet. You can repurchase shares. Quite often, closely held businesses have multiple owners and with different liquidity needs. I'll show you an example of a repurchase in a little while. Establish a management buy-in. These are things that are fairly easily implemented, and we can do that. A leveraged dividend recap, a leveraged stock recap, an employee stock ownership plan. These are things that we can do with private businesses if we have the time. And I say we, that is you as a business owner and your team of advisors. We can accomplish a lot of very good things if we have your attention and your decision to move forward. And then finally, you can do a large leverage dividend recap. I believe in using leverage for closely held companies, but I don't believe in using excessive leverage. I would rather lever up and pay a special dividend, pay it off over a few years, and then do it again, rather than submit the company to the risk of 5 or 6 turns of EBITDA in terms of leverage. I think much more in terms of 2 to 3 turns for transactions that I think about. In my experience, many business owners won't use leverage other than for the operation of a business. They won't use leverage to create liquidity from their businesses. I received a call in November from a lady, had a voicemail at 8 o'clock on a Monday morning. What that tells me when I get those kind of calls is that somebody was thinking about something over the weekend. When I talked to her, she said, would you come up and talk to us about dividend policy? Now, the company that she was referring to was a $200 million revenue business, earns about $40 million in EBITDA. It's a subscription-based, beautiful business model, worth $400 million if it's worth a dime. Well, they called me up to talk to them about dividend policy. You see, they had bought the company from Dad over a period of years and had paid Dad $60-some million stretched out. So all of the money that they had made was used to pay off Dad. They had no money, literally, outside of the company. And they were having, as they described it, loving discussions about what to do with dividend policy. There was some disagreement as to what to do because the guy that ran the business had no liquidity outside of the company. One of the sisters had about 18 million. She had saved her shekels, as she said. Well, the other one was in between because she had had a divorce and had to buy back some of the ownership that was equitably accorded to her husband. So we're talking about dividend policy, and it just dawned on me, this company has no debt. It's an ideal candidate for a leveraged dividend recapitalization. So I talked to a couple of their outside board members on that trip. I talked to the folks at the company, the 3 shareholders, and their family advisor. And I suggested out of the blue that they consider a $100 million leveraged dividend transaction. Well, I think I put them in shock. I went home. I didn't hear anything for a couple of months. In late January, I got a call, and they said, would you come back and talk to the shareholders and the board? Our CFO is going to put together what looks like a $75 million leveraged dividend transaction, and we'd like to talk to you about it. I said, well, sure, I'll come back. Well, I didn't get the transaction documents, so I didn't get the workup from the CFO. And one thing I learned a long time ago is that actually my boss at First Tennessee had Roger's rules of meetings. He said his first rule was never go to a meeting without your own set of numbers. And his second rule was, if you're so foolish as to ignore my first rule, then never go to the meeting without the ability to create your own set of numbers at the meeting. Now, he didn't have a calculator back then. He had a Marchant calculator. He'd take it, put it on the board table, and plug it in. And then he'd do a 10 key and create his own set of numbers on the fly. Well, anyway, I created my own set of numbers for a $100 million deal. Suffice it to say that that was less than 3 turns on EBITDA. So it was not a particularly risky thing. The shareholders reduce their risk because they take money out of the company. There's a little more risk on the company itself, but they've done the $100 million recap, and now they've each got maybe $25 million liquid outside of the company. Because these are the kinds of things you can do with a little bit of leverage. Private equity firms do this all the time. in the last few years, there have been hundreds and hundreds of private equity transactions where the private equity firms were unable to sell their investment companies, their companies, at prices that they wanted to sell them. So what have they done? They've done leveraged dividend recaps, paid dividends to their investors, and they still have the investments in the company. Dividends and dividend policy. Dividends come out of earnings. With private companies, though, there's a little bit of confusion with dividends. Net cash flow is the earnings that are available to a business. Many business owners don't think about net cash flow, but it's the earnings net of all taxes plus depreciation, less CapEx, plus changes in working capital, plus any change in long-term debt. That's net cash flow. Every business has a net cash flow. There are four things you can do with net cash flow. You can pay dividends, you can retire debt, you can reinvest for future growth, or you don't reinvest in stagnant assets. Stagnant assets would be building up cash. What happens when you build up excess cash on a balance sheet? Well, I'll tell you what happens. What happens is that the rate of return goes down for all the shareholders. And that's a price that every shareholder pays, even the controlling shareholder that makes that decisions. So let's look at the annual return for a closely held business. The annual return would be dividends plus any unrealized appreciation or depreciation over the beginning value of the business, except with a closely held business, many pay out what I would refer to as discretionary earnings, discretionary benefits. Discretionary benefits might be salary in excess of the a market wage. I wrote a blog post a few weeks ago about Martin and Steve. Martin and Steve are two business owners. They each have a $3 million sales business. Their businesses generate about $600,000 in discretionary cash flow. Well, Martin is getting close to 65. He called in a business appraiser and said, what's my business worth? The business appraiser said, well, $600,000 of discretionary cash flow. Your market wage is about $200,000. That leaves $400,000 for normalized earnings. 5 multiple on that, your business is worth $2 million. Martin says, oh my goodness. He has been living on $600,000 for the last 20 years and has very little savings, and he finds himself in a position where if he went $2 million times 6%, that's $120,000. I'm living on $600,000. What am I going to do? Steve, on the other hand, got the same appraiser who got the same $2 million valuation. Steve, though, had a financial advisor. Steve has been living on $300,000 of the $600,000 and taking the other $300,000 after taxes and investing it. He's got a portfolio of $7 or $8 million that he's accumulated over the last 20 years or so. His financial advisor says, you know, Steve, you're going to have $1.5 million selling the business net of taxes. You're going to have maybe $8 or $9 million. I'll let you have 4% on that to live on. That'll be about $360,000. But you're going to be in pretty good shape because you have recognized that your business didn't make $600,000. You've lived on a little more than your earnings, but you've invested the return on the business. So the difference between Martin and Steve and a good retirement and not was recognizing those discretionary benefits and what to do with them. So calculate your rate of return on your business, but include the discretionary benefits that you pay for yourself. Dividends, I said every company has a dividend policy. I think that dividends are good. It's interesting. The dynamics of dividends are, I think they're compelling for managements of companies because once you start paying a dividend, management tends to focus on generating sufficient earnings to continue. Dividends are a way to generate return from a business, And so it's important to think in terms of paying a dividend, particularly if you don't have attractive reinvestment opportunities in the business. One of the signs that you don't have attractive opportunities to reinvest in the business is reinvesting in cash, marketable securities, and other kinds of stuff that people put on their balance sheets when they don't want to pay a dividend. So I would tell you that if you pay a dividend and you reduce the capital of the business by the amount of the dividend, what you'll end up doing is helping the rate of return for all shareholders in a business. So if you increase the rate of return, if you increase the return on equity as a result of that, then you will also, at the same valuation multiple, increase the value of the business in excess of book value. I call that market value added. So we all want a lot of market value added. Now the next section in the handout material is relates to tools to create liquidity. There are two tools that I have used successfully with client companies. One is the leveraged dividend that I mentioned with the company just early this year. The other is a stock buyback, leveraged stock buyback, which I mentioned with Norm. Now, the leveraged buyback is shown in the handout material beginning at page 36. And you wonder, why would you do a leveraged stock repurchase? Well, one of the reasons that you do a leveraged stock repurchase is to buy back the stock of an owner that needs liquidity or that is ready to retire. Because if you have a company that's in business over a long period of time, owners' needs for liquidity change, and they work. Yeah, that's fine. There you go.
Just hang out up here.
Okay. Okay.
I don't know if that's going to.
Well, this is the slide that's gotten it each time. Okay. Okay. Maybe it'll work here. We got Acrobat up top, but we've got a PDF now. Okay. So leverage buyback, leverage dividend. This is a situation. It's a real situation. This disguised, of course, but with a leveraged stock repurchase or with a leveraged dividend recap, there are a lot of moving parts, and the economics from the company's viewpoint is essentially the same. But here we have a company that has $250 million in sales. It's a nice, attractive company. It's got close to a 10% EBITDA margin, $24.2 million. Its return on equity has been declining. It's been declining because they've been investing in cash. I've been talking to the owners of this company for some time about paying a special dividend, but we did something else. The company had $16.4 million in debt and about $20 million in cash. So it's kind of a wash with liquidity. Working capital is 32% of assets versus 20% for similar public companies. You got $126 million of equity, 72% of assets, not very leveraged at all. It's currently paying a $3 million dividend, and that reflects a dividend payout ratio 27.5% of earnings. So what we're going to do is repurchase 30% of the business. An owner is retiring. So what does that do? Well, we know what it does for the owner that's retiring. It gives him $45 million to pay taxes and to live independently for the rest of his life. But so we're going to buy that 30% of the business. There's just too many numbers there. We value the company at 6 times EBITDA, and so we'll buy at the 30%. The return on equity goes from 8.6 to 12% on a pro forma basis. That's pretty nice. EBITDA margin is unchanged, of course. The net margin comes down a little bit because we have some interest expense that we didn't have. We got to put some debt on the balance sheet. And so we end up with a current ratio of 3.5 instead of 4.4. We're still very liquid for this particular company. So the benefits to the remaining owners, earnings per share up 29%, dividends per share up 43%, price to book up from 118% to 129%. The dividend yield goes from 2% to almost 3%. So it's a pretty good deal for the remaining shareholders without very much risk. So this is the kind of thing that successful private companies can do. I had a conversation, they're not a client yet, but I had a conversation. A wealth manager gave a copy of Unlocking Private Company Wealth, the book that you have available to you, to a business owner up in Minnesota. And this gentleman called me. He had 2 years ago sold, or was about to sell, almost 50%, just under 50% of his business at a valuation of $16.5 million to a private equity group. At 8 o'clock on the morning that he was supposed to close at 10 o'clock, he backed out of the transaction. He just got uncomfortable. Maybe they were trying to change something in terms of the employment contracts, or he didn't tell me at great length. So we talked to him, and I said, he told me about the business and the regularity of its cash flow. And I said, well, what would you think if we could not sell 50%, but if we could borrow money and say $6 million, and we take the $6 million, put it in the company, pay a special dividend to you and your brother, and create some liquidity. You can pay that off over a period of time, and you still own 100% of the company. He said, you know, I never thought about that. But we have documents flowing back and forth at this point. We're just kind of snake bit up here. But I'm not going to worry about it. The point is that we can. That's not going to help me. The point is there are a lot of things that we can do with private companies to generate liquidity outside of the business while maintaining control of a business if we think about it and if we work together to do that sort of thing. And when I say we, the we is your team of advisors that you work with. That would include a lawyer, a CPA, a wealth manager, someone who's handling insurance, a business appraiser, and so forth, because it takes a village to put some of these transactions together. But there are a number of tools of corporate finance that we can use. Well, anyway, there are a number of tools of corporate finance that we can use to create liquidity for businesses. Now, what I'd like to do for just a little bit is talk about buy-sell agreements. And I'm at page 50 of the handout material. A buy-sell agreement is an agreement between the owners of a business and the business itself that call for the purchase of stock when certain things, usually they're adverse, but when certain things happen. Those things are called trigger events. But buy-sell agreements require agreement at a point in time. They relate to transactions that will or may occur at some future time. They define the conditions that trigger the buy-sell agreement itself, and if they're going to be good, they determine the price that the transactions will occur. There are certain kinds of trigger events that we all think about. I use the acronym QFRDD: quits, fires, dies, retires, disabled, divorce, things of that nature. If you Google the D's of buy-sell agreements, you'll get a long list of Ds. In fact, I have a slide that has 20 plus Ds. I had to stretch a little bit with some of those, but there are a lot of Ds. So, but trigger events are not necessarily good things. Nobody wants to die. When we look at buy-sell agreements, there are essentially four kinds. There are cross-purchase agreements, and cross-purchase agreements are usually found with smaller companies. By the time companies get to have multiple shareholders, cross-purchase agreements become more difficult to manage. So of the larger companies, the kinds of companies that many people have, that many advisors work with, that have value of 3 to 5 million or more up into the billions, there are three kinds of agreements. There are fixed price, there's formulas, and there are agreements that call for a valuation process. Fixed price agreements, I think, are ticking time bombs. Fixed price agreements are really easy to put together. All you have to do is agree on a price. If you've just had a transaction, that's easy. Fixed price agreements always say that the price is in Exhibit A, and they always say that the shareholders will agree each year as to the new price. They just never do. I can tell you that I have seen buy-sell agreements that are fixed price that never had an agreed upon price. There are many fixed price buy-sell agreements out there that haven't had an update in a number of years. I have a client that we had done occasional valuation work for that had a fixed price agreement. They called it a certificate of value. That certificate of value was unchanged for 14 years. I finally convinced them to put in place a buy-sell agreement that called for an annual appraisal, and that has made significant progress. But the fixed price agreement, what happens to value over time? If the price is fixed at $10, over time value might go to 15, or it might go to 5. Well, if you come and there's a trigger event and value is 5 and you're the seller, that's not very good. Maybe it's favorable to the buyer. If the value is 15, well, if you're the buyer, that's not a very good deal. And all I can tell you is that that kind of situation is a ticking time bomb. Formula agreements are not much better. Lots of business owners want a formula. They're looking for the perfect formula, much like the Knights Templar search for the Holy Grail. But I don't think the Knights ever found it. And I haven't seen a formula that will work either. Suppose that the formula is simple: 5 times EBITDA. EBITDA is 2 million, and 5 times that is 10 million. Well, the agreement better say to subtract debt, or somebody's going to have a problem. I've seen several buy-sell agreements where there was no debt at the time that the formula was put in, but there was subsequent debt put on the balance sheet, and the formula remained the same. What happens in my simple example, if there's a $400,000 one-time write-down of inventory? So 2 million, 1.6, 5 times 1.6 is 8, right? So should the value be 10 or should the value be 8? According to the formula, it's 8. And the same thing with a non-recurring gain. Will overstate the value, because no formula can really determine all of those kinds of things. So I think formulas are ticking time bombs. Multiple appraiser process agreements are fairly standard in today's world. They're in the forms of many law firms. Many lawyers have them, and it's really straightforward. There's a trigger event, then the company hires an appraiser. The selling shareholder or his estate hires an appraiser. The two appraisers generate appraisals, and what happens then is that if they're within 10% of each other, then it's an average. In 30 plus years of looking at buy-sell agreements and looking at trigger events in buy-sell agreements, I've seen the first two appraisers within 10% of each other one time. Okay? What that means is that we're going to hire, the two appraisers are going to select a third appraiser, and the third appraiser is going to do an appraisal, or maybe not, but the third appraiser will do an appraisal. Maybe it'll be averaged with the other two. Maybe it will be averaged with the one closest to it. I've seen a situation where the third appraiser's conclusion, if it's within the range of the first two, is definitive of value. There are all kinds of logics that people create, but what I'm telling you is that buy-sell agreements with that kind of trigger mechanism, with that kind of pricing mechanism, have real problems. The basic problem is that no one knows what's going to happen. Because you see, we've assumed so far that the words on the page in the buy-sell agreement were clear as to what kind of value the appraisers would determine. I can tell you, I've seen it many times where one appraiser interprets the words on the page to be a non-marketable minority value. That's going to be the buyer, okay? That's the buyer's appraiser. The other appraiser interprets it to be strategic value. How did that happen? I don't know. Well, the slide that I showed you had 130 and 65. Those are representative numbers. I got those numbers from a real case that I was involved in. My conclusion was to be definitive of value, but the one was non-marketable minority, the other strategic control. So I took this 1.5 page buy-sell agreement, and I wrote 10 pages of analysis of the words on the page, determined that the value would be financial control. I came in at about 100. I did get paid, but I have not heard from either party ever since, because there was no way to satisfy anybody in that particular situation. So I would just tell you that they spent a lot of money in terms of the appraisals. In many cases, there's litigation. Quite often when there's a buy-sell agreement, someone dies. Well, and then the buy-sell agreement will say something like this: the parties have 30 days to agree on value. Well, what I'm telling you is the parties have 30 days to really get PO'd at each other. And once they're mad, then the fight is just beginning. It sounds like I'm just making this up, but when I've seen it 25 or 30 times, I can tell you that it's absolutely true. It's absolutely important when you're looking at buy-sell agreements that when the interests of the parties are aligned, that you get agreement on important things. Because I promise you, when there is a trigger event, the interests of the parties are misaligned. They become unaligned because the buyer wants to buy low and the seller wants to sell dear. It's just human nature. So you go through months, sometimes years, of fighting over value, and then finally you get to a price. I'm involved in one right now involving a minority interest in a sports team. And I've been called in to talk about what happens in buy-sell agreement procedures. I'm not even valuing the company. The transaction, the death that created this transaction was in 2010. I think it's 2015 now. But the parties have been litigating this issue for 5 years. And there's an arbitration in a couple of months, and maybe it will finally be resolved. So, but no one has known what this thing what was going to happen. What do I suggest? I suggest that if you have a successful, closely held business, and you have multiple shareholders with a buy-sell agreement, that you use a single appraiser where you agree on the appraiser today, and the appraiser values the company today. You get a draft, everybody sees it, you determine that yes, that's the financial control value that we all agreed to, you finalize the report, and that becomes the price. The next year, or at most in 2 years, you revalue the business, that becomes the price. The next year, you revalue the business, and that becomes the price. If there is a trigger event, then you've got the price set. Or you may say either party may ask for a reappraisal as of the date of the trigger event. What that does is provides certainty to the pricing, provides certainty for planning, provides full employment for just wanted to see if you're listening. But it's part of the 1% solution that I am talking about. Now, what I never get in front of a group where I don't make that recommendation. And increasingly, companies are buying into that idea because the certainty of what's going to happen. The client that I just told you about that had a 14-year fixed price agreement is now doing an annual appraisal that resets the price each year. I have to tell you that there were some young people that are trying to buy stock in the company. I don't know when I've had such a grilling, but we got in their boardroom and they had the draft valuation, and they were asking all kinds of questions. It was actually a very good experience for everyone because everyone knows that there was a legitimate valuation process, and while everyone didn't necessarily agree with everything, they agreed with the process ultimately. I want to talk for just a few minutes a little bit more about buy-sell agreements, because this could be, for some of you, a very important point. Many buy-sell agreements have life insurance associated with them. Not every buy-sell agreement that has life insurance associated with it has clear documentation as to what's going to happen when a trigger event occurs, when there is a death and cash comes to the company. There are two ways that the life insurance can be treated. One is as a funding vehicle, and as a funding vehicle, the life insurance comes to the company buys the stock of the departed shareholder, and that's that. The remaining shareholders increase their ownership significantly. If it's 50-50, the remaining shareholder increases his ownership to 100%. But if the company was worth $5 million and there's $6 million of life insurance, the company pays $5 million for the stock of the deceased shareholder. The company's now worth $11 million. And you know, I ask the question sometimes, is that fair? Well, that's not my decision. That's the decision for the owners of the business. The other way of treating life insurance is as a corporate asset. Now, we had the same $10 million business. The $6 million of life insurance comes in. The company's now worth $16 million, and I'm assuming net of tax, make life easy. So the price is now $8. So the company's got $6 million of life insurance, got to pay $8 million, so they got to borrow money to pay pay for the stock. Well, what that means is that it's significantly different. The results are significantly different. What I promise you is if the language is not clear in your buy-sell agreement, and there is a trigger event, and there is life insurance, there's likely to be disagreement and or litigation. I've been involved in 3 litigations. I testified in one case down in Miami a few years ago where the language was not clear regarding the use of the life insurance proceeds. The judge ultimately concluded they wanted a fair value to be determined by a neutral appraiser. Well, the judge said, well, you had an opportunity to change the agreement. You could have changed the agreement. You could have done anything that you wanted to, but you didn't. Your agreement says you wanted a fair value determined by a neutral appraiser. So the neutral appraiser decided that it would be a corporate asset as opposed to a funding vehicle. Now, there was language in documents that suggested that they intended it to be a funding vehicle. But the judge ultimately said the parties got exactly what they bargained for. They got a fair value by a neutral appraiser, and that's my finding in this particular case. So if you have a buy-sell agreement with life insurance, just go home and make sure, get your advisors to read it, make sure that the language is clear. If you have clients that have buy-sell agreements, you can add a great deal of value by just asking the question. If you resolve that issue or determine that it's not an issue, then you're going to be in much better shape. Jim, I'm unclear as to what time you want.
Maybe 5 more minutes.
Okay, sure. One thing I want to talk about is a concept that I call READY. Is a business ready for sale? And I use the acronym READY. The R in READY stands for risk. If you reduce the risk of a business, other things being equal, you'll increase its value. So what can we do to reduce risk in a business? Many private businesses have concentrations of one kind or another. The concentration might be with a key manager. The concentration might be with a customer. In other words, heavily concentrated with one or two or three customers. The concentration might be with a product. The concentration might be with a supplier. But any kind of concentration creates risk in a business. Bad things happen to good companies. You just don't want to be around when you lose the dominant customer. So the R stands for risk. The E stands for earnings, or EBITDA. It's always good to be focusing on the margin of the business, what's going on with the earnings, because the earnings are a significant determinant of value. I call the valuation triumvirate cash flow, risk, and growth. And if you look at the basic valuation equations, they're all cash flow, risk, and growth. The E is the cash flow. The R is the risk. So A, I call that, I'm cheating, it's people. It's the activities, the attitudes, and the actions of your people. Are they doing what they're supposed to be doing when they're supposed to be doing it? What does your company look like when people come see it? How do you present your company to the public when you answer the phone, on your website, when people visit your facilities? These are the kinds of things that I'm talking about here, and the kinds of things that we can work on over time. The D is for driving growth. We want to be driving growth in a business all the time because that's part of the valuation triumvirate. And the Y is year-to-year comparisons. What is the story of your company? What kind of story are you developing, and what kind of story can we tell if it's time to sell the business? What kind of story can we tell if we go to the bank and you want to borrow money to engage in one of these liquidity creating kinds of transactions? So ready. I view ready, the slide has like an hourglass or something like this. If you think about ready, I mean, just literally think about R-E-A-D-Y as you walk around any business, but particularly your own. Where am I seeing risk? What opportunities do I see to enhance earnings? Are my people doing what they're supposed to be doing? Does my company appear the way it should appear to the public, to my customers, to my suppliers, to all of my constituents? Am I driving growth? What can I do to increase growth? What can I do in terms of new products? What can I do in terms of selling more to existing clients? I mean, it all boils down to basic kinds of things. And what's the story? Is this part of the story that I'm trying to tell? Because if you think in terms of ready, then you'll be, it'll just change the way you are looking at your business. I was at an advisory board meeting in New York, maybe about a year ago, and this company's board was meeting, and I was sitting there, and they were talking about a number of things, and so I took my pen out And I just listened for maybe an hour and a half. I really didn't concentrate anything, but I wrote down on my little notes, ready, R-E-A-D-Y, and then I commented on 3 of them.